Welcome to Alpha Recap. Thanks for joining us after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. The trading day closed with that familiar two-speed narrative we talked about. Winners tied to AI and big energy projects, and lots of headline-driven volatility elsewhere.
Right. Markets closed with a two-speed story on February 27th. Technology, energy, and utilities finished the day up, while crypto, cannabis, and parts of consumer and media were more mixed or volatile.
So, what really stands out here is the scale of a few funding and project headlines that showed policy and capital flowing into big transition plays.
Exactly. The biggest single headline was the Department of Energy loan to Southern Company. It was $26.5 billion, a record-size commitment that changed the calculus for big utility projects.
That was huge. It wasn't just symbolic. It meaningfully lowered execution risk for grid and offshore projects and probably helped lift utility stocks today.
And energy itself had a strong day. Renewables wins. Hydrogen hubs and more disciplined oil markets pushed sentiment higher. There were also several clean energy project wins, including an offshore award of 2.6 gigawatts and a U.S. materials plant priced at about $1.25 billion.
Materials also got headlines. Rare earth expansion, record recycling numbers, and that big plant. All support the onshoring narrative for electrification supply chains.
On the tech side, AI and cloud momentum continued. We saw product and scale headlines, OpenAI scale and funding chatter, and Amazon planning a stateful AWS runtime that drove buy-side interest in cloud infrastructure and GPUs.
Right, and PwC's forecast that automation could more than double by 2030 tied into that theme. Industrial automation, semiconductors, and software got a lift from the AI story.
At the same time, regulation and policy headlines capped how broadly that rally could run. Crypto had inflows into spot Bitcoin ETFs, about $1.1 billion over 3 days. But regulatory pressure on exchanges kept the sector volatile. Not a great day for certainty there.
Yeah, that tracks. The ETF flows were supportive for price and liquidity, but enforcement headlines around major platforms kept miners and exchange-exposed names under pressure.
And then there were a few big corporate cash moves that changed narratives. Netflix was in the headlines with a $2.8 billion termination payment. That kind of number impacts content economics and fueled speculation about consolidation, especially with chatter about a tie-up between some big media owners.
Big content money. Honestly, I was a bit surprised by the size of that payment. $2.8 billion is material, even for big streaming players.
Short reaction.
Wow, that's big.
Short reaction.
Not what anyone expected.
We also saw liquidity events and private market valuations. Plaid employee liquidity priced around $8 billion, so capital is rotating. Buybacks in energy, refinancing in real estate, and private liquidity all suggested redeployment rather than hoarding.
Right. And the other thing is, corporate capital allocation seemed active. That matters because it can fuel M&A or buybacks, which in turn lift certain sectors more than others.
Let's walk through the cross-sector themes, because they explain a lot of the day-to-day moves.
Okay, theme 1. AI was cross-cutting and market-moving. Product-level moves in cloud and model scale drove demand for compute, storage, and specialized chips. That pushed tech and certain industrial automation names higher.
And the correlation point is simple. Winners in cloud and AI often lifted suppliers, chip makers, data center equipment, and enterprise software. But if AI safety or regulation became front-page news, that could flip the script quickly.
Theme 2. Clean energy plus big financing changed sector alignment. That DOE loan showed the federal government was ready to underwrite scale, which read across to utilities, transmission developers, and grid tech suppliers.
Theme 3. Liquidity and capital allocation were active. We mentioned buybacks, refinancing, and private market liquidity. Those moves can create outperformance for companies returning cash or doing strategic M&A.
Theme 4, and this one kept showing up, was regulation as the primary volatility amplifier. Crypto enforcement, cannabis compliance issues, telecom litigation, and healthcare payer friction all reminded investors that policy headlines can blow up a narrative fast.
Short reaction.
Policy headlines move markets.
Let's unpack the most consequential moves and what investors should have been thinking when these stories landed.
Start with the DOE loan, $26.5 billion to Southern Company. Why it mattered? It wasn't just a check. It was a signal that large-scale grid and transition projects could get federally supported financing. That reduces financing risk and could lower the cost of capital for other regulated projects.
Investor takeaway. Favor utilities with clear project pipelines and regulatory frameworks that allow cost recovery. Transmission, offshore wind developers, and grid tech suppliers could see de-risked returns.
Next, spot Bitcoin ETF flows of about $1.1 billion over 3 days. That provided liquidity and price support, but the underlying crypto outlook stayed bifurcated because enforcement and miner stress remained.
Investor takeaway there was tactical. ETFs were the cleanest way to get BTC exposure, while miners and exchange-linked names carried more execution and regulatory risk.
Netflix's $2.8 billion termination payment and speculation around media consolidation reinforced that scale and distribution still matter. Content owners with strong libraries and distribution leverage could be M&A targets.
AI infrastructure and product moves. OpenAI funding chatter and the AWS stateful runtime plan. Translated into clearer revenue pathways for cloud providers and specialized hardware vendors. In other words, the AI narrative was becoming monetization talk rather than pure hype.
Materials and supply chain investments were another big read-through. The rare earth expansions, recycling wins, and that $1.25 billion plant supported onshoring and reduced concentration risk for electrification supply chains.
And biotech had one of those cleaner stories, a spin-out with about $270 million in cash. That cash runway increased optionality and lowered near-term dilution risk for investors.
Health tech momentum around AI also showed up as a separate upside path. Platforms that can combine clinical data with AI to drive payer acceptance or workflow savings looked more attractive than pure R&D plays without clear financing.
Let's be practical. What should investors have done given all this?
Actionable Insight 1. Be selective within the AI trade. Shortlist. Cloud infrastructure leaders. Think AWS, Microsoft Azure, and Google Cloud Platform equivalents. GPU and accelerator suppliers, and enterprise software companies that can monetize AI through subscription or usage fees.
Avoid the speculative, cash-burning startups without a clear path to monetization or regulatory compliance processes for AI-sensitive use cases. I mean, when you step back and look at this, monetization mattered.
Actionable Insight 2. Favor utilities and energy names with secured financing and regulated returns. The DOE loan showed that projects with a financing backbone and transparent rate cases were lower risk than merchant-exposed developers.
Actionable Insight 3. Tilt into materials plays that have visible offtake and onshoring stories. Rare earth producers, recycling leaders, and plants with near-term capacity. But watch commodity cycles. Polysilicon pricing pressure was flagged as a risk today.
Actionable Insight 4. Treat crypto as tactical not core, in 2026. ETFs provide cleaner access to Bitcoin price action. Miners and altcoins carry execution and regulatory risk. Limit position sizes and avoid leverage on exchange-exposed names.
Actionable Insight 5. Prefer real estate names with balance sheet optionality and exposure to lower mortgage rates. REITs that could refinance, multifamily and industrial tied to logistics, and adaptive reuse plays converting offices to data centers or housing.
Actionable Insight 6. In healthcare, prioritize cash runway and AI-enabled differentiation. For biotech, look for names with more than 12 to 18 months of cash runway or clear catalysts. For health tech, favor workflows that save payers money.
A quick check of risks and watch lists. Regulatory shock remained the top downside. Crypto enforcement, cannabis uncertainty, telecom litigation, and possible AI rules could produce sharp re-ratings.
Execution risk on big projects mattered too. Even with the DOE loan, permitting delays or supply chain constraints could push timelines and returns out. So don't assume every dollar converts into immediate revenue.
Macro and rate volatility was another watch item. Refinancing and real estate moves are sensitive to benchmark rate swings. And commodity cycles could swing materials earnings faster than fundamentals change.
Short reaction.
Stay nimble.
A few calendar items to watch. Any formal announcement on that media tie-up chatter, regulatory filings, or enforcement actions for crypto platforms. The DOE implementation details for the Southern loan. Plus, earnings commentary from the hyperscalers on AI monetization.
And scheduled clinical milestones from the well-capitalized biotech spinouts. Those are natural catalyst points that could move the tape for health names.
Final takeaways. Today's tape reinforced two durable truths for 2026. Thematic leaders like AI and the energy transition commanded attention and capital. And policy or regulatory developments continued to be the primary accelerant or brake on returns.
If you were selective, focusing on names with clear earnings paths, secured financing, or strong balance sheets, the day offered attractive opportunities. If you chased narratives without those filters, the day reminded you how dangerous that could be.
We kept seeing the same lesson: valuation discipline, cash runway, and regulatory awareness separated winners from headline chasers.
Thanks for listening. We hope that helped you make sense of a headline-rich day. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
See you next time. And don't forget to send your questions to stockalpha.ai.